Hi guys. Welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about how Bitcoin affects stock market. So make sure to watch the full video. Cryptocurrency markets have finally become mainstream. Cable financial news network tickers include popular crypto prices in addition to the Dow Jones, S&P 500, and Nasdaq benchmark index prices. Crypto ETFs, futures and options are increasing in liquidity and popularity. Most importantly, financial institutions and bellwether companies are not only acknowledging but investing in cryptos. This sparks the inevitable question of how crypto markets impact the stock markets. Cryptos versus stocks. While cryptocurrency markets still pale in market capitalization compared to the stock markets, they share many similarities. Both markets are tradable on a general level, though liquidity varies vastly as the broader stock market carries much more liquidity. Institutions dominate the stock market and are in the early stages of entering the crypto markets. The stock market is a much more structured and regulated environment with added investor protections. The crypto markets are still very risky without a governing regulatory body. In fact, crypto markets are all about decentralization, which goes against the idea of single governing regulatory body. Stocks and cryptos move based on supply and demand, i.e. buyers and sellers. However, stocks have fundamental and quantitative-based intrinsic valuations based on the underlying company performance metrics. Cryptos in general have no intrinsic value since they don't represent underlying companies with quarterly earnings reports to gauge the performance of the business operations. In that sense, it could be argued that cryptos are a more pure supply and demand-driven market. In recent years, cryptocurrency, particularly Bitcoin, has proven its worth, with 14 million Bitcoins currently in circulation. Most of the present market capitalization has been driven by investors speculating on the prospects of this new technology. This is expected to continue until a certain level of price stability and market acceptability is attained. Aside from the proclaimed price of Bitcoin, individuals who invest in it appear to be depending on the cryptocurrency's presumed inherent worth. This covers the technology and infrastructure, the cryptographic code's integrity, and the decentralized network. One of the primary reasons cryptocurrency evolved organically is that it is not subject to any regulating organizations such as central banks or other banks before a transaction is validated. As a result of its decentralized network structure, which employs a peer-to-peer payment network based on blockchain technology. Such virtual currencies serve as an excellent alternative to the monetary system, fiat money. Supply and demand. It's common knowledge that producers and consumers substantially impact product and service prices. These factors influence the cost of shares, and it seems that they often affect Bitcoin. There could only be 21 million Bitcoin formed, and the future supply is reducing as demand grows, driving the price. Other cryptocurrencies will follow suit as investors investigate them for potential investment possibilities. No consumer protection. The current procedures provide a basic system for consumer protection. The proliferation of cryptocurrencies has resulted in numerous crypto-to-crypto and crypto-to-fiat crypto exchanges with significant regulatory gaps. Cryptocurrencies have yet to accomplish the stature of a unit of account that is inherently related to stable prices or inflation targeting. Until this is accomplished, the disruption to a central bank's standing is just partial and not complete. The continuous study to establish price stability through using Bitcoin on a blockchain would pave the road for stable coins. The monetary policy signal will be broadcasted over the blockchain, and a stable coin will immediately challenge the present legal tender and be a total replacement. The emergence of an asset class. While several global macroeconomic factors, such as expected negative yields across mature economies for a longer period, equity markets at historic highs, and record levels of liquidity injected by central banks, have fueled recent interest in cryptocurrencies. Significant social factors such as FOMO, fear of missing out, genuine curiosity, and speculation are creating a new generation of crypto asset investors and traders. Bitcoin will reach $60,000 per unit in April 2021. In June 2021, its worth will have halved. Bitcoin's source code stipulates that there will only be a finite amount of 21 million Bitcoins generated, hence the asset's scarcity creates value, and people believe in its worth. However, this kind of volatility is difficult for the typical investor to bear. The faster and greater return of cryptocurrencies in 2020 demonstrated the robustness that more knowledgeable investors sought. However, how cryptocurrencies go from here, as well as the attendant volatility, will be closely monitored by investors who have been waiting to invest. Economic conditions. The state of the economy has a significant influence on investment pricing. The economy grows and shrinks through time, as measured by gross domestic product. It follows natural cycles, although macro events might push it into certain parts of the cycle. For example, the COVID-19 epidemic in 2020 brought an economic slump, a brief recession, and falling stock market values. Geopolitical issues. Since import tariffs or other political activities can affect the supply of resources, labor forces, transportation, and other factors, political choices between nations impact the stock market and cryptocurrency values. As a result, people who invest in assets influenced by political events are concerned about price volatility and purchase or sell by their opinions. Market performance. Cryptocurrency and stock markets are favorably associated. As a result, volatility in the crypto stock markets will influence stock market performance. After rising to new highs for much of 2021, the price of significant crypto tokens plummeted by 40% to 50% in May. Following the massive sell-off by cryptocurrency investors, the stock market plummeted. It's tough to say how much the Bitcoin slump has influenced stock prices. The rapid drop in crypto values, on the other hand, is a signal of a larger problem, one that might damage equities that have nothing to do with crypto. What does it mean for investors? Trading in the cryptocurrency market serves the same goal for some people as investing in the traditional stock market. Profit, possession, and motivation are the three simple reasons why people have already been investing in the stock market for centuries. And the cryptocurrency market fulfills all of these requirements. Cryptocurrencies allow investors who want to go worldwide to do so simply. While investing in equities outside of your nation is time-consuming, the alternative, crypto trading, may be advantageous for genuinely global investors. Initial coin offerings have gradually supplanted initial public offerings. Investing in firms that launch ECOs is so simple that it may soon be chosen over traditional ways by practically all investors. Eco Bench is a business that lists ECOs from over 70 different companies and demonstrates that cryptocurrencies are beginning to affect stock markets. Also, in India, cryptocurrencies are slowly but steadily gaining traction. Millennials from Tier 2 and Tier 3 cities are flocking to crypto. Women's engagement in crypto trading has increased by over 1,000% in recent years, even though men have dominated this field. 66% of all users are still under 35, indicating that crypto is more popular among the country's youth. Due to distrust toward banks and other financial institutions, the thrill of turbulence, and the availability of digital technologies and digital sources of information, Gen Z and millennials are significant investors in this field and will continue to be. Peer-to-peer networks have aided in the widespread acceptance of cryptocurrencies among tech-savvy youth. Growing widespread adoption of cryptocurrencies will also have an impact. Final thoughts. While the market keeps an eye on potential regulatory changes, effective governance is critical to the effectiveness of blockchain to protect participants, investors, and stakeholders. At the same time, it also makes sure that the system is resilient in times of systemic risk, privacy concerns, and cybersecurity threats. Blockchain technology can revolutionize the financial services industry, particularly in terms of automating market monitoring and post-trade event processing. The technology claims to solve the challenges of deleting information, data fragmentation, market manipulation, margin system review, reconciliation, and ticket matching. However, realizing the full potential benefit of restricted mutual public blockchains and smart contracts would need significant adjustments in business practices and investments from companies, essentially on both the buy and sell sides of the sector. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.